There are 6 shocking investing mistakes people use while doing personal finance all the time, it seems like. Let's talk about over-diversification, because you hear portfolio managers and advisors preach diversification.
Yeah, absolutely. I mean, once you get past 20 stocks in your portfolio, you're pretty much approaching mirroring the market. And if you're trying to actually outperform the historical market average of 9–10%, there's no way you can do it when you have that many stocks in your portfolio.
You may as well just buy the SPY ETF.
Exactly.
Right. So let's talk about Robo Advisors. It's great that investors have so many tools at their disposal, but is everyone following the same formula?
Well, there's that. I mean, everybody being managed by advisors and various resources is pretty much following the efficient frontier in modern portfolio theory. So Robo Advisors have done a great job of reducing the fees that people used to pay to get mediocre results. So now they're still getting those mediocre results, but at lower fees.
Now this is interesting, tax loss investing, selling from your winners to pay for the losers that your advisor had suggested. How does that come into play?
Yeah, tax loss harvesting is, it's a good concept. You know, you unload a particular stock to capture, to realize a capital loss, and then you purchase a similar stock and proceed. But, you know, if that's one of the lead points as to why you should use a robo-advisor, you know, we're going to help you, you know, make more of your losses. You know, that's not selling.
Right, it seems very counterintuitive.
Right.
Let's talk about the age limit, because if you impose one on yourself, you could actually limit your returns.
Yeah, you know, I mean, life expectancy is going up. So, you know, traditional advice has been when you're 65, 70 years old, move everything over into income-oriented investments, maybe yielding 3–4%. But the reality is you could be living for 25 more years. So we advise for a bucket strategy, which is very common. You know, put everything you need in the next 5 years into cash, safe investments. Maybe you have a 5 to 10 year bucket as well. But everything that you need more than 10 years, you should be going aggressive for at least, you know, SPY returns.
Following that, is $1 million enough?
That's a reflexive answer when you ask people how much money do you need for retirement. It just sounds like a nice big number, right? But it's really not. I mean, if I'm going to retire at 65 and I'm going to live to 95 and I'm going to need $100,000 a year, that's $3 million right there.
So our 6th mistake that we're making is believing your advisor can do better than you can.
Well, I mean, you look at the stats, and of course, you know, most people do not outperform the market. Most mutual fund managers do not outperform the market, and DIY investors do not outperform the market. So if all these people are not beating the market, why don't they just put it in SPY if 10% is enough to get them to where they need to be?
So we take all these 6 mistakes and we look at it from one bigger picture. What's Baton doing that's different than other advisors?
Yeah, so we're a tool that can step in. If you've done the math and determined 10% is not going to get you to your goal, we have a 16% historical average in the real world, not back-tested advice that goes back to 2003. Our founder, John Reese, who founded the algorithm, he basically created an artificial intelligence model around how 10 of the world's greatest investors pick stocks, mostly value-oriented investors like Buffett and Lynch and so forth.
It's a fascinating strategy. I've met with him, and it was really interesting to see how the model works. Thank you very much for coming in, Phil.
Thank you.
For TheStreet in New York, I'm Jill Malandrino.